Good morning to all of you. This is Professor Ramana. We'll discuss today some questions relating to EVA, that is economic value added. We will try to understand how to calculate EVA and what will be the effect of EVA if the situations or the capital structure or the profit changes. What is this EVA? As we have mentioned previous in one of our classes, that EVA is another performance indicator and addresses the two important limitations of return on investment. There is a financing anomalies and accounting anomalies, but for the time being in this discussion we are ignoring the accounting anomalies and concentrating only with the financing anomalies. So to revisit, I'll say that EVA is a net operating profit after tax but before interest minus the capital charge. So EVA is NOPAT minus the capital charge. To explain that, let me take you to a simple example where there's a balance sheet is given. Okay, the balance sheet is given, the income statement is given, there is a PAT, profit after tax, of this company is 259. So therefore the company is having return on equity as 259 crores divided by equity. Equity is 500 plus 1500. Okay, so the company is having a return on investment of in the form of return on equity as 13%. So but if somebody will say that the company is not able to generate or create wealth for the shareholder, of course you can see the return on equity and the cost of equity and get an idea that the company is already destroying the wealth of the shareholder. But in order to show it very clearly, they say that it's better to understand the economic value added. As we saw here, economic value added is a net operating profit after tax minus capital charge. We have to calculate NOPAT, we have to calculate the capital charge. So the NOPAT can be calculated, as profit plus interest minus the tax benefits of interest. Okay, so let us go back to our Excel. So I'll say PAT, I'll take from the income statement, then add back interest, okay, plus interest. So therefore I'm adding back interest and deduct less the tax benefits or tax shield, okay, tax shield of interest, so into 0.30. so therefore the NOPAT is 326. We'll discuss that bit later, why the tax shield is deducted. I can also calculate NOPAT by PBIT or by using PBIT. So PBIT is 466, then less tax, as we have seen tax is equal to 0.30, so therefore it is NOPAT is 326. Whether you calculate from PAT or PBIT is not an issue, you will arrive at the NOPAT. To summarize the calculation, I say that NOPAT is PAT plus interest into 1 minus T. Okay, so therefore it is PAT, okay, PAT plus interest, that is minus this one is 326, and or I can also calculate as PBIT into 1 minus T, which we calculated here. So therefore NOPAT can be calculated in a different ways, but whatever is the way, you should get the same answer. Now, so we got the NOPAT. Now the next issue is the capital charge. Capital charge is a charge for using the equity and interest bearing liabilities. So in this case, equity is 500 plus 1500, and the debt is given here, and I'm not taking creditor because it's a non-interest bearing liability. Equity, we have already taken. The cost of equity is given for us 20%, and the cost of debt, it is post-tax interest rate, so therefore 12% into 1 minus t, 12% into 1 minus t, and the t is here 30%, so therefore the cost of debt is 8.4%. So if you multiply the cost with the amount, then you get the value of the, so 467 is the capital charge. So we have NOPAT, we got capital charge, so EVA is equal to NOPAT minus the capital charge 467, so there is a negative EVA. The company is making a return on equity, accounting return 13%, but it is having a negative EVA of 141. If I calculate that as a rate of return on, okay, the return on investment by using the EVA, so in that case it is 141 divided by 141, or in other words, okay, I'll not use that, NOPAT divided by the capital employed. Okay, so you can see that there is 11.6% is the return the company is earning. However, the cost of using that money is much higher. Therefore, the company is making a negative EVA. So EVA, to recap, is a NOPAT minus the capital charge, and NOPAT is calculated by PAT or PBIT. So in order to make this number more meaningful, let us take a decision by seeing the capital structure or the balance sheet. Suppose I say that the same business with the same NOPAT will have a different capital structure. What will happen? So I just copy this for the time being and paste here and paste here. Okay, so, and I just observe, I'm just making the change. I'm not changing the total, so therefore I'm making the capital 400, debt 400, and reserves 400, and the bonds 2000. That means I've changed the composition of capital employed. I've changed the debt and equity, my NOPAT remaining constant. So if you see that, in this case the NOPAT has, the EVA has improved. The EVA has improved not because the NOPAT has improved, NOPAT is same, but the capital charge has changed. But the capital charge has changed not because the cost has changed, the capital charge has changed because the composition of the debt equity has changed, keeping the total capital employed constant. In the previous case also, the capital employed is 2,800. Here also the capital employed is 2,800, but the composition of the capital employed has changed. As a result, negative 141 has improved to negative 1.8. Now let us further once again copy that, and this time make a slightly different assumption. Okay, so I say that I take this forward, and then instead of changing just the debt equity ratio, we just observe that the company is having 1/3 of the total assets in the form of cash. So why not to use that cash? So that means I'm saying let us pay dividend and then see the impact on EVA. Okay, how much dividend you can pay? You have reserves of 1500. If you want, you can pay the entire reserves as a dividend. Suppose I pay 1000. Okay, so therefore the reserves will go down to 5,500, and cash will go down to 50, all other things remaining constant, the sources and the assets reduce to the extent of 1000. As a result, the equity and the debt or the capital employed reduces to 1800, and you can see the debt, the cost and equity cost remaining same, the NOPAT remaining same, because the composition as well as the amount has changed. NOPAT EVA is no more a negative, but EVA becomes positive. The positive EVA in this case, once again, is not because of the operational improvement, but because of the changes in the capital structure. And in this case, the changes happened because I distributed dividend. So sometime distribution of dividend may lead to improvement in EVA. So changing the capital structure either by changing the composition of debt and equity, or changing the capital structure by distribution of dividend in the form of cash, is having an effect on the NOPAT and is having an effect on the EVA. But suppose the company declares a dividend, but instead of declaring the dividend as a cash dividend, it declares the stock dividend. Okay, suppose I'll say declares stock dividend. Okay, so let me write down declares dividend in the form of bonus shares. Okay, in the form of bonus shares. So in that case, the company is declaring the dividend, but there is no deduction in the cash, but the reserves are converted into the capital. So my new capital will become 1500, and the reserves will come down to 500. So therefore the composition of the capital equity changes, but the total equity remains same. So EVA is not changing. So that means that management of EVA has to see, you have to see whether you want to change the capital structure, whether you want to change the cost of capital, whether you want to change the NOPAT, or whether you want to change the size of the asset itself. So EVA gives you that perspective to understand the operating decisions, financing decisions, and investment decision. So I can write down like this. Okay, EVA. Okay, so let me put one more slide. So I say that EVA can be managed. Okay, can be managed by managing the following. Okay, by managing the following. What are those? They are you can either manage the NOPAT, or you manage the weighted average cost of capital, or you manage the capital employed. So managing NOPAT is managing the operating decisions. Managing WACC is managing financing decisions. Managing capital employed is managing investment decisions. So therefore you can improve EVA by managing OD or FD or ID. In some of our future sessions, we will try to understand the same EVA by taking into account or taking examples of each of these decisions and examining the effect of those decisions on economic value added. Thank you very much.